Hey everyone, Chris Haddon with Hard Money Bankers here with another awesome expert interview. A couple special guests we have today. Our own accounting firm, not our own accounting firm like we own it, but the accountants who handle all of our business and personal matters for HMB, for our real estate company. We have Abba Blum and Maral Nakashian from the accounting firm in Rockville, Maryland, MN Blum. Thank you guys for being with us. Thanks for taking time.
Thank you.
Thank you.
I'm sure you are kind of short on time. It is tax season and everything after all, but we do have some interesting stuff to go over. Jason and I hosted a mastermind group of business owners and real estate people, some of the best in the area, you know, guys who own hundreds or more properties, buy many each year. And even with these pros, no one's that clear yet on how the new tax changes are going to affect them, which are, you know, we don't have to worry about them for tax prep quite yet. It's just taken effect now in 2018. But if you could break down what you're comfortable with so far, what you know about so far related to people who own investment property, and then also maybe even in addition to that, company owners who are buying real estate through a pass-through entity, which seems to be most of them.
Great. Happy to do that. So we see this new tax law, and while it's still evolving in the sense that the law has been passed, but it hasn't been codified yet. So we're just going to give you our opinion on what we see out there and some of our advice to the people listening. And we'll break it down in, let's say, three major areas. And the first is the new tax law is going to give people who purchase, renovate, and then sell real estate the ability to deduct 20% of their profit right off the top before paying tax. And that 20% applies to all flow-through entities. So it applies to S Corps and LLCs and partnerships. And even in the case where some people may be owning the real estate personally, they should also qualify for this 20% deduction.
Having said that, we would like to ensure that there's, as we know, in the tax world, there's nothing straightforward. Although this deduction is available and it may apply to all the investors, we will make sure that they do consult with their tax advisor when the time comes, because there's a lot of tests they need to meet.
For sure.
And there are some restrictions, but it's very important when they meet with their advisor to make sure they're clear that this 20% is applicable to them, and they really do need to see if they can apply it to the maximum extent.
Okay. Yeah, just to clarify real quick for the people watching today, the thing to look out for, to run past your tax advisor, if you are buying, rehabbing, and selling investment real estate through a pass-through entity like an LLC, partnership, et cetera, you might be eligible to take 20% deduction, 20% off the top, and pay taxes on the 80%, which is a big number. So definitely look into that carefully. Now, moving on, buy and hold rental properties, obviously a big part of what people do in the investment real estate world. Has anything changed with that? And is anything going to change?
There's been a few changes, and then there's been a lot of misinformation in the marketplace. And the biggest question we're getting asked now by clients is, should they switch to C corporation? Most of our clients that own real estate, in fact, all of our clients that own real estate, own them through flow-through entities like LLCs, S Corps, and partnerships. And the tax rate has decreased for corporations down to 21%. And when I say corporations, we mean C corporations. And so the question gets asked to us, do we think, should our clients switch to C corporation? And at this point, based upon the knowledge we have, we don't think that they should switch.
Another angle to look at this, which will definitely affect your audience, is anyone who's buying real estate for rental, whether it's one or two, they should always now buy it through a pass-through, because the 20% deduction is applied on a pass-through level. So if an individual owns rental property with their name, they're not going to qualify for the 20%. But if they own it through an LLC, then they will qualify for the 20%.
Oh, okay. Yeah, that's a good distinction there. Because that would not apply on a personal level. That would not apply to people who own in their personal name. Okay. Interesting.
And so the C corporation is very important to watch, because a lot of people are going to be talking about it. And a lot of people are going to say they're converting to C corporation, but we're pretty clear at this point, it's not our recommendation and it won't save you taxes in the long run.
Got it. Okay, that's good to know. So real estate investors, if you own property out there, don't go jumping ship to a C corporation quite yet, unless something changes. Now, something that came up, and it's slightly related to this, but definitely related to people's tax prep and planning in general, is a lot of people get confused between a pass-through entity and passive income. Active versus passive, and then pass-through entity. Obviously, it's the same word. Easy to get the concepts jumbled together. And could you speak a little bit on that, break that down, the difference between the two?
Yeah. Sure. When they say pass-through entity, all that means is it's any type of income, passive, ordinary. It's just coming from a partnership with an entity that is preparing a return, issues a K-1 to the investor. That K-1 is considered pass-through income. There's no distinction whether it's passive, ordinary, capital gain. That is a pass-through coming to them through another investment, not their own personal return. That's what pass-through means.
Got it. Okay. Income coming from this company. Yeah. From
yes.
And then the active or passive thing, if you could, because that's very applicable to real estate.
So passive defines the type of income. And so under Reagan, the tax code was changed, and it said that you have to break your income into 3 buckets. Your income is one bucket is your salaries and your wages for what you do for a living. The second bucket is your portfolio income, which is your interest, dividends, and capital gains. And then the third bucket, which got created, was this bucket called passive income. And that's your investments that you make in real estate or in a restaurant or in some business which is not your own vocation. And so there was a distinction made that if you were, let's say, example, a doctor's business is being a physician. That income is his active active income. If he then in turn buys or invests in a restaurant, that's a passive income. So there are 3 different buckets of income. And what the law said is you can't use a loss from a restaurant, from a passive activity, to offset your business income from your active business. So with real estate, it's a very complicated animal, because if you're a doctor, an accountant, or a lawyer, and you invest in real estate, that's passive income. So it's irregardless if it's comes through a flow-through entity, it's passive. Now, it is possible to be actively involved in real estate. You could say, I'm in the business of real estate. I'm not a doctor, I'm not a lawyer, I don't have another career, and I am a real estate investor or a real estate developer. In that case, the same type of rental income that would be passive to a doctor is not passive to a real estate entrepreneur. And that's where we get the confusion, is that a lot of people think real estate automatically is passive, but it really depends on the nature of what you do for a living.
And to take this to your audience, if your audience are investors who are going and buying properties and they're renting it, if all they do is they manage the building that they're renting, they collect the rent. If something breaks, they make a decision. Well, this investor is no longer an investor. He is actually managing the property. He's got 2, 3 of them, and that's all they do. Then IRS says, for you, even though it's real estate, but because that's all what you do, it's not passive, and you can use the loss against any other income.
Got it. And doesn't the IRS have a test, like an hours limit? If you spend X amount of hours per year on real estate, then that is active versus passive? What's that figure?
Yeah, if in a case of your investors, if I am an individual who's doing it, I don't have a management company. A simple way I can put it is, although the test is complicated, but the easiest one that would apply to our audience here is one individual has 4 or 5 properties or 2, 3 properties, and they manage it themselves. In that case, if there's no management company, the easy test is, if that individual spent 500 hours in a year doing this, then he says, I am the only one spending that many hours, then I meet the qualification. At a minimum, 500 hours a year. 500
hours a year. Okay. So yeah, everyone keep that part in mind. And also to make it even a little more complicated and nuanced. I understand, because we've been through this recently, that you could even have active and passive income going on inside one business entity. Like in the case of owning rental properties versus buying and reselling, or maybe you're a home builder and that's your active part, but you own a small building, which is passive, to further complicate things a bit more. So I guess the right answer is that people should be very detailed in approaching this with their own tax advisors and talk about the different options, because there's just many factors. Is that right? That influence somebody in real estate and how this is going to apply to them.
Good.
Correct. First, they have to determine what they are. And if they're a home builder, then that's their business. If they have a few rental properties on the side, they won't qualify, and those rental properties will be passive income. But if they're a property manager, and they're a property manager and a real estate owner, then you can say, well, that my business is owning and renting real estate. So your first test is, what am I? What is my vocation? What is my career? And the IRS always asks that question first. What are you doing? Now, if you're an employee of another company, it's going to be very hard to say that your income is not passive. If you own your own company and your company has different divisions, which is what you were speaking to, Chris, then you also would have that problem that within one company, you could have part active, let's say you're building homes, and part passive, let's say you're investing in rental properties. And so that distinction becomes very critical when you have the multiple lines of business.
It's important for them, before they go out spending and investing, to have a conversation with their advisors to say, maybe we set up one LLC that's just going to invest, and everything that comes in there is passive. Let's set up another one that's going to be more on our line of business, and it could be ordinary. So you keep the bucket separately so it's not tainted.
Got it. Okay. That makes good sense. Okay, switching gears for a moment, talking about some of the new tax changes coming up in business versus personal. Abba, you mentioned briefly to me that you could see it playing out for a lot of people in our space, companies like ours, that we are going to get some benefit on a business level, and we're going to give some back on a personal level. Could you talk a little bit about that? I know that you did cover most of the business stuff, but the personal things coming up as well.
Sure. So the concern we have from the individual level is one of the biggest changes is there's a limitation on the amount of real estate taxes and mortgage interest that can be deducted. On the side of real estate taxes can only be deducted up to $10,000 per taxpayer. And that $10,000 includes the real estate taxes and their state income taxes. And so we have a significant concern for individual taxpayers and home buyers, meaning the customers of a lot of the people listening today are going to have a limitation on the amount of real estate taxes they can deduct on their return, and thereby have an effect on what they might be willing to pay for a property.
Okay. The concern we have that most taxpayers will be subject to is they reduce the tax rate as far as the federal income tax rate. So now everybody's excited and they are taking home more in their W-2 paycheck because the tax rate went down and everybody's like, oh my God, I'm bringing more money. But what they're forgetting as well is all the deductions they used to take, which is their state income taxes, their real estate taxes, they no longer are deduction. So at the end of the day, they will owe taxes with their return because the withholding is less and the deductions are gone. So people need to be careful with the extra money they're bringing home. At the end of the day, they may have to give it back. So don't go spending it all because, again, you've lost deductions that no longer exist.
Got it. And do you think that'll push people to start using standard deduction more often and not itemizing as much?
My guess was going to be anyone who has a mortgage, if their mortgage interest expense is higher than $14,000, then they're going to use not the itemized deduction because they get $10,000 flat for the real estate and they get $14,000 plus for their mortgage deduction. And if they are doing charities, then they definitely will not use the standard deduction because they can get more through their charity, through their mortgage deduction and the $10,000. But if someone is renting and they don't have a real estate expense or they don't do charity, then they will definitely take the 24,000 standard.
Okay, so it sounds like it would be a pretty quick and easy side-by-side comparison to see which results in a better bottom line.
Right.
Okay, very good. Now, like I mentioned before, this is taking effect in 2018. We are not preparing taxes for 1 year under this new plan. Is there anything that people should be doing this year to prepare?
This should be 2018 or 2017?
Starting now in 2018 throughout this year to prepare for this new setup on a business level mainly is what I'm thinking about.
Yeah, I think the most important thing is to have that conversation with their accountant now. I mean, we're having many conversations with our clients to educate them on this, to make sure they're doing all they can to take the 20% deduction we talked about at the beginning, to make sure they've done the analysis and convince themselves that they need to own their real estate through separate LLCs and not in a group and not in a C Corp. And they really need to understand who their customer base is to see if these laws, like the limitation on mortgage interest or the limitation on the state income taxes and real estate taxes that Maral spoke about, will affect their customers and how they can adjust to that concept.
Got it. So yeah, just get out in front of it basically and see how it's going to affect you now. And if anything needs to be adjusted, then it can be. And of course, always consult your tax advisor and so on and so forth. Anything else that you would like to mention on the subject that maybe I didn't ask in particular? Did I cover most of it?
You did. You covered everything. The only thing is this is evolving. The tax law passed only a few days ago, and this tax law came at record pace. The last time a tax law of this magnitude went through Congress, it took over a year. This tax law took 64 days. So we are expecting and anticipating many changes and corrections and modifications. And so this tax law, while it has passed, is very fresh and will go through changes, and they'll need to at least pay attention to it or make sure their accountant pays attention to it and informs them as these things evolve.
Yeah, that's the part. Is that the news stories that came out at the very end of December or maybe earlier in December when that happened, it could be a different animal in 6 months from now.
Right.
Okay. Yeah, that's important to know. So for people in our audience who might have questions or want to follow up with you, where can they find you? Where can they reach you?
If they want to send us an email or through a phone call, we're available. The company phone call is 301-337-3300. This is our main line number, and both Abba and I will be available to answer any questions, or through an email, which will be, and my email would be Maral, M-A-R-A-L, Maral at mnblum.com, or Abba at mnblum.com.
Okay, and we'll post all of that contact info too. There's a good chance that people are looking for accountants who specialize in real estate and also are on top of these new tax changes. So you could definitely get some. What was that? You're going to mention something else?
We're not the cheapest people in town.
Yeah, so, nor should you be.
Right.
You get what you pay for.
Exactly right.
We aren't the cheapest people in town either.
I know, just worth saying.
Fair enough. All right, guys. Maral, Abba, thank you for taking the time. Of course, in the middle of tax season, so we definitely appreciate it. And yeah, we will talk soon. We have lots of work to do.
Great.
Thank you.
Thanks.
Thanks again.